Good morning, and you are welcome to the next lecture on advanced variances. So here we are going to talk about the advanced variances. So we've already dealt with the basic variances, and here we look more advanced. Now, in the advanced variance, we're going to discuss about 4 areas, and I have it written down here. We are going to talk about the planning and operational variance. Operational variances. And I have here mix, so material mix and yield variances. Sorry. And we're going to talk about sales mix and volume or quantity variance. Sales mix and quantity, or you can also call it volume variance. All right. Then lastly, we will talk about the sales market share, sales market share, and market size variances. So these are the 4 we are going to look at, but this video will cover 1 and 2, then the next video 2 will cover the 3rd and 4th one. All right, so basically that is that. Now, why are we doing these advanced variances? We did basic variances, and in the basic variances, it helps you to actually appraise sector heads, all right? But it doesn't go details into certain specifics. But here, the advanced variances will go into certain specifics, all right? So as we go into it, you must try and understand each one of them. Let me bring myself up here. All right, so that is that. Okay, so it means that we need to go ahead and talk about the first one, which is planning and operational variances. Planning and operational variances. All right, so in the basic variance, what we learned was that we learned the standard. You have the standard, you set up substandard or budgeted results that you wanted to meet, right? And you measured it with the actual results that actually happened. And by that, you had your variance. Was that not it? You had your variance. Or better still, in between this and this, you have your variance. And you analyze that. Was that not it? That's what we did. And we called it what? We called it basic variance analysis. Basic variance analysis. But you see, the truth is that from the time that you plan something to the time that actual results are obtained, time is not constant. Like everything that you have there is like nothing will change and a perfect or an ideal standard. But you won't have that. So reality kicks in. Reality will kick in. Now, when reality kicks in, you see there is a timing difference between the time that you did your standard and the time that the actual is realized. Between that, certain things can change. And if things are changing, then it means that you also need to make some changes. For example, we did labor variances, right? Standard labor. Just in January, the minimum wage in Ghana, even up to now, was around 18.15 cedis minimum wage. So let's say you use that one to do your budget. But now, as I'm talking to you, the president of Ghana, the current president, that is John Dramani Mahama, has increased the minimum wage, to 19.97, a 10% increment they did. So basically, that is what happened. So 18 points multiplied by 1.1. That is it, 19.97. That is what has happened. Now, are you going to say that when you did your budget, you use this and the HR has paid higher, and therefore, if you compare your budget to the actual, and this is cost, labor cost, it will be an adverse? Because that is what it clearly seems. So if I do 19.97 minus 18.15, I get 1.82 adverse. And you are going to judge that manager, all right, to have paid more salary. But think about it. Was it his fault? It wasn't his fault, because it is a law that the government has passed. And if you don't do that, that manager will rather be penalized, because the entity will be served with sanctions. So is it good to say that this man has rendered you down? Because the adverse means that your profit is going to go down by that figure. Look at it. So this is per day. So it means each day your profit is going to go down by 1.82 on each labor. So you see, you cannot blame that HR manager for going through this. All right. So what you can then do is look at realities. So that means that given what has happened, the time we did this budget, it means that we need to revise this budget to bring in the new thing that has happened before we can judge the manager. Is that clear now? So it means that what we are going to do is that with this standard that we set, the standard that we set here, we now need to come here and do a revised standard. A revised standard. A revised standard. So that we can use the revised standard to actually judge the actual result. So if the revised standard now is 19.97, or let's say let's say we did 18.87, so now we do 19, you cannot go beyond the below the budget, the minimum, so you use now 19, and the actual results went like 20, then it means there will be rather an adverse of what, 0.03. Do you now get it? So this is what is happening, and therefore that is the core. So the difference between this original budget here and the revised one is an issue of planning, because that is budgeting, planning. That is why we have the planning variance. And the issue of the revised versus the actual gives us what? I think you can now see that it gives us what? Operational variance. All right. So, ladies and gentlemen, that introduces to you the planning and the operational variance. Now, if we did not change, you realize that we would have used this to compare with this if we did not revise, and that would have resulted in a planning error. And the planning error will penalize the entity, because these are legalities and it will affect the company. And therefore, you realize that we had to change things. We had to revise things because changes happen. All right. Now, these changes that happen externally beyond the entity. It's the president that did that. It wasn't the entity. So you see that these changes are externalities. All right. So we call it externalities, or what? External changes. External changes. changes, for example, like what you've seen, minimum wage, inflation rates changes. Inflation rate changes, the entity cannot do anything about it. Exchange rate changes, the entities cannot do anything about it. All these things, the entity cannot do anything about it. And so these external changes or factors are what we call uncontrollable cost. The one that managers don't have control about. So we are talking about uncontrollables. And so therefore, it is very unwise to use planning variances to appraise entities. So we do not use planning variance for performance evaluation. But unfortunately, do you know in the real world, people are actually using that? That is very unfair. So you need to revise. Then when you revise, then you compare with the actual. Now you can see that you can now appraise well. So here, what you are seeing is that if there is any variance, the variance will be caused by management. So these variances are caused by internal factors of management. Internal factors of management. And so therefore, we can use this one for performance evaluation. All right, so ladies and gentlemen, that is that. Why can we do that? Because these ones, the things are controllable. They can be controlled. All right, these are because they can be controlled because it comes by their actions, the management actions. All right, so ladies and gentlemen, this is it. All right, so now how do we then go in there to do the calculation of everything? So if you are asked to give in figures in the question, how then do you calculate everything? Now let's see how we would develop our formulas. Let's see how we would develop our formulas. Now, planning and labor operational variance can be for labor and material, all right? Because if you look at our cost structure, we have direct material, we have direct labor. These are variables, all right? So that is that. So we can do that for material, labor, and even overheads. But here we are going to restrict ourselves to material and what? Labor. So let's look at how we will develop our formulas like we did in the basic variance. Now, let's do that for, so let's say planning and operational variance. No, the operational is actually the activity, all right, what you do. Variances for materials, but you can do also for labor, okay? Can do for labor. So let me put here labor. And let's use this side for the material, okay? So how we do it for material, and let's use this side for how we will develop our formula for the labor. Now, remember, when we were determining labor cost, what was our formula? The labor cost variance. Material cost, all right? Material cost variance, and we are looking at labor cost variances. So how were we doing it? I think you remember, it is your standard quantity. Is that not it? Multiply by what? Your standard price. And this was the standard one, the budgeted. Okay, the budgeted. Let me write it well. Standard or the budgeted. Now, how did we develop our actual? Do you remember how we developed the actual? The actual was determined by what? Actual quantity multiplied by what? Actual price. So, actual price. This is what we did. All right. And so, do you remember all we need to do is that we are going to change certain things small. Here, we change this thing to revised standard quantity, because remember, we said that you change something here. You have to revise it, all right, and use the thing to appraise with the actual. So we change this one, but we keep our price. We keep our price, our selling price, right? Because if you remember when we were doing the material, this was how we used to do it. If you remember that we had standard quantity by standard price, and we have actual quantity and actual price. And the material, we have material usage variance, and we have what? Material price, or yeah, the price variance. And so all we had to do then was that we changed this to AQ, and we maintain our SP. Do you remember? And we developed, so the next one, you maintain AQ and you change this to AP, all right? And this is how we develop the formula. If you remember, we use the top here, and we said that standard quantity minus actual quantity. So if we were talking quantities, we were looking here. I think you remember. All right. Standard quantity, actual quantity, multiplied by what? SP. You remember now? Good. And when we wanted to know our price, material price variance, what did we do? We use this. And so we said that it will be what? Standard price minus actual price, AQ. You remember it now. So this is how we develop our formulas for the material, the basic. This is basic material variances, material cost variances. And this one was for usage, material usage. And we realized that if we actually use more than this, it will be adverse. But if we use less, it was favorable. All right. And this one was what? Material price variance. I think you remember that now. So this was how we developed the formula. I went straight away and gave them to you. This was how we developed the formulas. All right. So now, so when we come here, all we need to do is to bring in the concept of the revisions. All right. The concept of the revision. So this is it. And now what we are going to do is that we now need to revise our price RSP. Here we maintain our RSQ. Is that not it? That is it. So these are how we are going to develop our formula. So lastly, we change this one to AQ, and we maintain our RSP. Why don't we have RAP? Because you cannot revise an actual. An actual is something that already happened. All right. So we are going to develop our formulas from these. All right. So from here, the first two here, we can develop our planning usage variance. Planning usage variance, the number of quantity that we are going to use. So here will be what? Planning usage variance. Then, so what do you think the formula will be then? Looking at it is clear, right? So this one, we can get it by standard quantity minus revised standard quantity multiplied by what? Standard price. There you go. That is it. Then when we pick this side, also of the box, we will be able to obtain our planning, what do you call it? Planning price variance, just as we had planning price variance. What would the formula be now? Look at it carefully. I think you get it now. It will be what? Standard price minus revised standard price multiplied by what? Standard revised. The revised standard quantity. Easy peasy. Then we take this one, these two. What do you think we can develop from that? We can develop our operational usage variance. What do you think the formula will be? I think it is clear, right? Looking at it, we will use our revised standard quantity minus our actual quantity multiplied by what? Our RSP. Sorry. So that is that. So we have the usage variance, operational usage variance there. All right. Then the last one, what do you think will happen? We are looking at this last one. And what do we think we can glean from? We have operational price variance. And what do you think the formula will be? It's simple. Look at it carefully because you have AK here. So it will be what? RSP minus AP. We are talking prices. Actual quantity. So this is it. We can do this and we can do. So when it is labor, it's the same thing. Okay. So labor, how did we do the budget? The standards. The standards were obtained by standard hours multiplied by standard rate. Is that not it? And how did we get our actuals? Is actual hours multiplied by actual rate. So the same thing, revise this one to revise standard hours and maintain your SR. Now change your SR to revise standard rates whilst you maintain your RSH. Then now, what do we do again? We change this one to actual hours whilst we maintain the RSR. Can't you get the formulas from that? You can get it. All right. So that is that. So whether it is efficiency or the labor rate is the same thing, because efficiency is about the hours. So you can get operational planning for the first part. So it will be like this. Sorry. So get all your formulas from it. All right. Then lastly, don't forget in labor, we have the labor rates and we have what? The efficiency. That's the hours. So these ones will be for your labor rate. All right. For planning. So the same thing, planning cost. I mean the rate. Planning. So the planning hours that you are planning efficiency. So this is RR, this is S, the hours. Planning price, all right, for the prices. So you have this and this, the rate, this will be constant, and so on. All right. The same thing for operational and operational. So don't forget in labor, when it is the difference between the hours, we call it efficiency. When it is the difference between the rate, we call it what? Rate variance. All right. So ladies and gentlemen, this is it. All right. So isn't it good? I think you can develop this, can't you? So if you are developing this one, what will it be? This one will be between the hours. So planning, efficiency, right? Which will be what? Given by SH minus RSH, then SR. All right, the same planning rate. What will it be? We have SR minus RSR multiplying what? RSH. Then operational. What do you have? RSH minus RSR. That is it. The last one, operational rate. You have RSR minus AR, actual hours. So you can do this. All right. So this is it. So now, why don't you take an example and work it out? All right. So let's see. We have this example here. I think we will work about 2 examples, then we move on to the next variance. All right. So now what we have here is that the standard cost per unit of raw material was 520 per unit. That is the standard. It was. So the standard cost, all right, so standard price was 5.2. However, due to subsequent improvement in technology and general market prices at the time of purchase was the revised one. It was, so the revised RSP, the revised standard price is what? 5. All right. Technology reduces cost of things. All right. Then we have the actual price. That is 5.18. And 10,000 units of raw material were purchased. And we have been asked to calculate the planning. And so if you go back here, you take your formulas, you can just absorb it in. All right. So planning price variances. So where is your planning price variances? This is your planning price variances. And quickly, you see that this is your formula. All right. So you can use any of these. You can sit there and say that what is the revised standard price? So you say revised standard price, which is sorry, we are doing price variance. So this is planning. They said we should do planning price variances. So this is planning price variances. So you need your revised standard quantity, and you are multiplying it by your standard price. And you also need the revised standard quantity again, all right, and you are multiplying it by the revised standard price, and you obtain the variance for the two. So if you look at the pricing system, what was the revised standard quantity? So this is it, revised standard quantity. So the quantity is there, it's 10,000. Okay, so that is it. Then we have the raw materials. It says that the 10,000 of raw materials were purchased during the period, but the prices, you see the changes in the prices. All right, so now let's do that. 10,000 units multiplying the standard price, which was 5.2. That should give me about 52,000. Then we have the same 10,000 units multiplying the revised one, which is 5. And here is 50,000. So there is a variance of what? 2,000. Now let's do the interpretation of the variance. The interpretation of this is that this variance is favorable. Now, why is it favorable? Listen, you planned, and at your planning, you plan to deal with the price at 5.2. Technology has reduced your planning to 5, your price to 5. Is that not favorable? It's favorable because you plan to do the thing at 5 point. technology has brought it to 5 for you. So it means that you have a favorable situation here. Right, so that is that. And another thing you can also use, easy way you can also use that. If you go by this formula that I have done here, if you go by this formula that is here, so long as you start with the standard first and you get a negative, that one will be an adverse. But if you start with the standard first and you get a positive, that is a favorable one. So when you start your standard, so basically that is that. All right. So in this case, that is it. If you started with the standard, you look at this, started with the standard, right? And here you have then the revised one. This is it. All right. And mind you, this wasn't within your control. This was uncontrollable because it's planning. Uncontrollable. So the uncontrollable thing has now turned into your favor. All right. So that is that. So anytime you have the revised being lower, because it means that now you are being efficient in your budgeting, given market circumstances. All right. So basically that's that. But remember, like I said, that you could do this thing like this. You could do SP. Sorry. You could do SP minus RSP, because this is price, or by RSQ. You could do that. All right. How would you have done that? The SP is 5.2 minus what? 5, and all multiplied by 10,000. And that would have given you the 2,000 straightforward. All right. And because it is positive, you have favorable. We started with that. All right. So take note of that. So analyzing the positive and the negative is very, very important. All right. So you plan the thing at 5.2. By technology has reduced the price. Price is going down. Hallelujah. That is it. Let's look at the other one, which is the operational material price variance. And operational material price variance is going to be sourced from here. Is going to be sourced from this green line. So it means that we have AQ, RSP, AQ, AP. All right, so that is that. So you could say AQ, RSP. Then we have AQ what? SP, right? Sorry, AQ, AP. Sorry. AQ, AP, the last line. All right, so, and you know you can develop this thing into RSP minus AP into bracket AQ. All right, because we did planning, we are now doing operation. So you have all these things here. All right, I think the actual quantity is 10,000. All right, so that is that 10,000. So here will be 10,000 units multiplied by the revised standard price, the RSP, which is 5, and that should give us 50,000. Then AQ, actual quantity, which is still the 10,000. Then you have the actual price. What was the actual price? The actual price is 5.18. So that is 518 then 0.00. Yes, that is what it will be. All right, so just to be on the safer side, yeah, that is that. All right, now let's analyze in terms of whether it is favorable or it is adverse. You revise your budget to 5, but you bought a 10 at this. But you could see, apart from it being a negative answer here, I mean, you can see that you, even when you revise the price to 5, you still couldn't, you still bought it at something higher. So this one is actually an adverse. All right, so that is that. So this one was within your control. It is operational, so it is controllable. It means that we couldn't control it. All right, so if you use this approach, it will be 5 minus like this 10,000, and this is going to give us trade adverse. All right. So basically, that is that. All right. So get the interpretation well, and that will be that. So this is what we do in planning variance. So now we pay attention to material usage and yield variance. Material usage and yield variance. So let's go to material usage and yield variance. Planning is done. The next thing is material usage and yield variance. All right, so this one too, I'm going to use the same simple analogy, all right, to go over it. All right, so let's go now. So let's start with the material cost variance, the basic one. So in basic, we learned that material cost variance, not material price and usage for now. It is material cost variance. What we learned in basic, we learned that we will need our standard, right? And the standard, how did we get the standard? In the standard, we said that we will need the standard quantity and we'll be multiplying it by the standard price. All right, so that is that. Then the actual will be actual quantity multiplied by what? Actual price. Then remember what we do? We change this one to AQ while we maintain the SP. All right, this is what we do. Then, so this one now changes kind of. All right, so now what we did was that the quantity gives us the usage. Is that not it? So this one will be material usage variance. And what would the formula be now? Clearly, the formula will be the standard quantity minus the actual quantity, standard price. Good. And if the standard is higher than the actual, then it means that the thing tends to be favorable. Is that not it? Yeah, because you budgeted, and what you did actually you used lesser than that. But if your actual tends to be so much higher, then it means that these are within your control. But here the care we solve in the basic variance that we must understand that this should be the standard quantity for actual production. And this is the actual that is also used in the production. So that is something that we have to remember, all right, because of the concept of idle time and all those things, and wastage and all those things. That's why we need to draw your attention to that. All right, and now we have this side as well. And what would this side give you? This side would have given us standard price minus actual price, actual quantity. And what was that? Material price variance. You remember, right? Right, so this is how we developed what we did. Now, in material mix and yield, we are going to focus on it's about usage here. Which one should I use? Material mix and yield is a usage variance, not about pricing. It's a usage variance. Okay, so how do we look at that? Now, adaptability in terms of material mix and yield. We are looking at a situation whereby two materials are blended to produce one product. So that is what we are looking at. All right, the material yield and mix variance. So we are having a situation whereby you need two or more materials. more materials that are proportionately combined to produce a product. All right, so that is that. So basically, that is the thing we are looking at. Now, what does this mean to our production? We must understand that in this situation whereby you will need two or more materials to produce, it can't be a fixed. It can't be that without that we cannot produce that particular product. But we are looking also at situation number two, when these materials are also interchangeable. So when the materials are interchangeable. So let me explain to you. When we say these materials are interchangeable, what do we mean? Let me give you an example. If you see the jacket, I decided to bring this. I hope you can see this one, the jacket that I'm wearing. Now, the jacket that I'm wearing, sometimes when you buy it, they will tell you that it is 100% wool. Now, when it is 100% wool, we cannot use material mix and yield variance analysis. But let's say that the thing was 50% wool, cotton, or let's say wool, and 50% cotton or rubber. All right, so that is that, rubber. No, let me not even use the suit. So let's come back to a Ghanaian, more of Ghanaian context. You've heard of this food before. We call it rice water. All right, rice water. Now, let's say you can see clearly that it is a mix of water and rice. All right, so and probably sugar content. But let's say I don't take sugar. All right, and let's make a rice water. Now, let's say this product is 60%. No, yeah, you let's say 60%. No, let me make it other than that. People say I don't know how to prepare rice water. Let's say 45% rice, and let's say 55% water to produce the product called rice water. Good. Now, let me ask you a question. This is the two products that we are talking about, and we said they are interchangeable to produce. Now, it's a product of rice, right? If I change this side to be 55% and I change this side to be 45%, I'll get rice water. But what kind of rice water will I get? So you see that it changes something, all right? The mixes changes something. Okay, so that is very, very important. So if you don't mix it well, it changes something about the whole product, all right? So let's therefore come to the purpose of the mix and yield. So why we are trying to learn all these things we are learning. So we have some few questions to answer, and I've written them here, which answers the purpose and the purpose of the mix and yield variance. All right. So the first thing I'm going to talk about is that number one, do we reduce the quality or we improve the quality when we change the mix? So quality improvement. So that's the first thing. And how do you know the quality? You can see the quality improvement from your revenue, because if people are buying, then it means that your product is of more quality. Is that not it? It's quality. Again, the feedback from customers. What kind of feedback do you receive from the customers? All right, so that is that. So we changed the usual pattern and we want to see how customers are responding to that. Is that okay? Number two. The second question that we want to know is that, do we increase quantity? Is there quantity improvement? If I change the mix, will I be able to produce more of the product? All right, so that is it. And the last question, and this one, of course, you will see it by the number, the volume. Then the last question we need to ask ourselves is that, does it reduce our cost? So cost reduction. When we change the mix, cost reduction. I was watching this documentary about Adidas, that it used to be that the very down of Adidas, where the Germans, when they started wearing it, they weren't comfortable with it, and therefore the guy Adidas has to now switch to using the car tie to do the down of the shoe. And so the mixes, as he changes it, and is there cost reduction to it, and is there improvement? Is he able to produce more? All right, so that is that. Basically, that is what we are going we take into consideration when we are trying to analyze the material mix and use variance. But let's go back to the formulas. How do we develop our formulas? So that when we get a calculation figure, we can use a calculation question. We can use. Let me see that time. All right. So now, first of all, you must understand that mix and yield are from material usage variance. So you must understand that it's not from the price variance, it is from the material usage variance. So how are we going to do about this? Now let's look at it. Let's look at how we're going to develop our formulas. So if you pick how you do your material usage variance, remember we said that this is not about price. So first, what did we do? We said that we needed, in the material cost, usual cost basic variance, we needed standard, right? And the standard was standard quantity multiplied by what? Standard price. And the actual, the usual material cost variance, the actual was what? Actual quantity multiplied by what? Actual price. All right. Now, we are talking mixes and yield here. And so all we need to do is introduce in the mixes. So what we are going to do here is that, you see here, before then, we changed this thing to what? AQ, as we maintain what? SP. All right, that is that. Now, look at it clearly. Very, very clearly. We are not going to use anything about price because we said that this thing is about usage variance. So all that we're going to do is to go ahead, maintain our AQ. Again, just a copy and paste, all right? Then we bring in standard price. Why? Because we don't need price variance yet. We don't really need that. Okay, so that is that. Here we are, it's a product of usage variance, okay? So now this is what we have. How do we then develop our formulas? Now, all we need to do is that, because we are doing standard mixes and yield, we will introduce in standard mix here. We will introduce standard mix here. And here, we bring in the actual mix. So basically, that is that. So this is very, very simple. So if you want to know your yield, all right, yield, we are using this one to develop our yield. The first two will give us our yield. And here will give us our mix. mix. So basically, this is it. So now, if I want my yield variance, material yield variance, it is going to be, and here is what a material mix variance. It is going to now be for me, I think I need, let me shift here. I need more space for this. Oh, video is up. Okay. So what do you think my formula for material yield is going to be? Look at it clearly. I know you can deduce from it. So it will be SQSM, actual quantity standard mix, minus, sorry, standard quantity standard mix minus actual quantity standard mix multiplied by price. Simple, right? Then here too will be what? Here will be actual quantity standard mix, actual quantity actual mix, standard price. All right. Why not actual price? Because here we don't do price. It's about the materials. All right. Here we don't do the actuality of the thing. All right. So basically, that is that. I told you that mixes and yield are product of what? Usage variance. All right. So basically, this is how you develop your formula for that. So what is left for us to do is to now use these formulas to go and practice. So let's go and see with questions. All right, let's go. Did I go too far? System is also slow. I think I went very far. All right. This is sales variances. Yeah. So here we are. Oh no, we've done all these things. Let's go to the advanced variances. For just a minute so that it doesn't eat into your time. All right, so here we go. We have the material mixes and the usage variance. And also, yes, of course, because of these wastages, all right, materials are sometimes lost. And so I told you that when we look at the standard quantity, we are looking at standard quantity for what? Actual production. All right, it's very key. We mentioned that actual quantity for actual production. All right, so that is where our basic variance was about. Okay, so if you look at what I did here, what I just explained, somewhere here, yeah, for actual production. So that's what we are talking about. All right, so now we come to our yield and mixes. All right, don't be confused to put the mix first because this one starts with the yield. All right, so if I want to go down to bring in about the yield, so let's look at the yield. I'll come back to the examples, don't worry. So we are looking at the yield, all right? So this is it. And you see in over here, I change the formulas slightly, all right? I bring, what I'm doing here, I bring the standard first, but here you can see that the, what do you call it? The actuals come first. But in reality, in working it, I prefer it this way. So probably maybe future, I need to change the book to suit this one, all right? So, but you are watching the video, all right? So that is that. So what you are going to do is to pick, if you are using a yield, what you are going to do is that, first of all, you must calculate this ones first, standard quantity. All right, so let's go to the materials and come to the yield. Let me show you. So this is your the procedure for doing the, the concept of the mix. So do this one first. All right, so that is that. In the previous book, it was do the AQAM first. But I mean, look at it. Look at the formula. So you do AQSM first. All right, that is that. You have the data for that. Then number two, you do this one because the price is just a standard thing. All right, so that is that. Then you determine the difference. So like I told you, so step one, step two, get the difference. All right. Then when you get the difference, you multiply it by the price. All right, then you get your mixes. So in a tabular form, this is how it will look like. Okay, so let me shift this one here so that you can have it here like this. All right, so this is how it will look like. All right, like I said, in the previous book, you may have the AQ AM first. All right, but let's try and understand the whether you have a favorable or you have an adverse. All right, so that is that. So here you are looking at when lower cost materials are used or the mix results in cost savings, then it means it is favorable. Basically, that is that. When lower cost materials are used, all right, so that means that we are looking at a situation whereby the cost of the material that you use, not the quantity of the material that you use. All right. So when lower cost materials are used, all right, then it means that the thing is favorable. But when higher cost materials are used, all right, or the mix increases the cost, then it means that it is adverse. All right. So you will see it, what we are coming to do. All right. You'll be comparing the standard to the actual and you will see. All right. So now let's pick up an example. I think the best way to always do this is to pick up an example. All right. So that is this. So let's look at this example. Let's look at this example. Handle. So we are looking at handle. Now, handle operates in a standard costing system. We have the standard cost of 1,000 units being given. All right. Then for the information that you are provided here, these are the materials. All right. So that is that. And please be careful. We are dealing with mixes. And I told you that it is the proportionate 50% of this, then that. So in the moment you see these ones, the standard that is here, then it means that what you need to do, the first thing you need to do is to check out the mixes. All right. So the standard mix SM here will be, you total this, total 600 plus 240 plus 630, 360. That is 1,002. So the total here, as the first thing you need to do, is 1,002. So the total is 1,002, meaning that if you pick material grade A, the proportion will be 600 over 1,002. B will be 240 out of what? 1,002. This is the mix. C, it is what? 360, 1,002. So that is the first thing you need to do. And you will need actual mix. Actual mix. And these are the actual information. So the actual mix is also given in quantity terms here. So you have 14,000 plus that is 11,000 together. That gives you 25,000. So it means that if you are doing the actual to A will be what? 14,000. All right. So that is how the mix will be. So 14,000, the actual thing that has been used. All right. So that is that. You have 14,000 out of that, this out of that, this out of that. But you need to understand that these are that. All right. So basically that is it. Okay. So you have that. You have that. Okay, so this is the proportion of things that you have, and that is the actual that has been what used. Okay, so the first thing we said that you would do here in terms of the formula, all right, is to do the actual quantity. And this is the actual quantity. Actual quantity that was used. Actual quantity of this, actual quantity of this. That is the one that has been used, all right? So that is it. So in terms of the material mix, the mixes of the material, and the product that was produced is 21,000 units, all right? So you need to get all these things in perspective, get the understanding of this before you even start the work. All right, so now let's set up your table. It's a very simple thing. So for example, if let's start the table like this. So we have the materials, material A, B, and C. All right, that is that. And you can do your standard mix. All right, you can do your standard mix somewhere here. And we know that the standard mix, but you did it upstairs, but you can decide to put it inside your table. So the standard mix is 600, 1, 2, 240. These are your mixes. 360,000 too. But what do we need actually? Because if you check the formula, we need AQSM. All right, AQSM. So what is AQSM? So here we do AQ. Is it AQSM first? Yeah, AQSM first. So you can do AQSM. But understand what you are doing, because AQSM is this. So what is AQ? Actual quantity. And we are going to do that actual quantity multiply by the standard. All right. So that is what we are going to do. Then we have AQAM. Is that not it? So that is that AQAM. We do AQAM. You find the difference. You multiply by the price. All right. Then you get your variance. Okay. All right. For example, if you want to do actual quantity and the SM, it's a very simple thing. Now, if you see this, these are variables of multiplication. You see that they are just variables of multiplication. So you just do multiplication. So let's do that. So if you want to do the multiplication, so this is the standard mix, multiply by the actual quantity. What is the actual quantity that was used? The total was what? 25,000. So 25,000. You can punch it on your calculator. You don't need to be doing these things. So if you do 600,000 by 25,000, that gives me 12,500. So it's me my AQSM is 12,500. But AQAM, so that one would have been, so 12, this is 12,000, sorry, 14,000, sorry, over 25,000 multiplied by 25,000, the actual quantity. All right, so it is still 14,000. So have you seen that? So as for these ones, you don't really need to bother yourself about the AQAM. You just pick them. So here I can boldly write this. It's 5,500. 5,500. But here is 240. So now it's 240 by 1,002 multiplied by 25,000. That is 5,000. Then 360 by 1,002 multiplied by 25,000. That gives me 7,500. So you see that at the end of the day, the AQ part shows up. All right. So here will be 25,000. Here will be 20, but you don't need to do these totals. It's irrelevant. Okay. So what is the difference? Here is 1,005, isn't it? Here is 500. But you can see whether it is adverse or it is favorable. You can clearly see from here. And this one too is like 2,000. All right. We needed to multiply by the price. And what price did we learn? Standard price. So what is the standard price for these products? and you are giving the standard price. All right, so the standard price is there. So here is 1.1, 2.4, 1.5. So let's do the multiplication. Okay, so this one is 1650. Adverse or favorable? You could clearly see it's negative. So it's what? Adverse. Have you seen that? It's simple. That is why I prefer using these formulas. All right. It's simple. Now, what does it mean? Actual quantity standard mix. So the the mixing that you decided to do for the actual quantity is this. But at the end of the day, actually, you exceeded it. And so it is an adverse, and these are controllable. So you could have controlled it in a way. All right. So it tells you that this is going to probably increase your cost. All right. And the three things that we mentioned there. So these are the things. It's either it increases. So it's either it's increasing this, reducing your quality, your quality, yeah, and probably reducing your quantity. But quantity, you see that probably if you wanted to do more, you are not probably doing more. But it may come from one of those things. So that is that. Then let's look at this one. Clearly, I think you can see that this one too is adverse, because when you look at this, that is that. So 500 multiplied by 2.4 is giving me 1,002. That is also adverse. I think this one clearly you can see is favorable, and that is uh, 2001.5. That is 3,000, and that one is favorable. All right, so that is that. But you can see this is adverse, adverse, favorable, and here will be 0. All right, so in total, if I total everything, here is 150. 150. And is it favorable or adverse? You could clearly see that this one is 2850. So here remains what? Favorable. But when you finish this, you can now use the three things. So it means at the end of the day, in terms of quality, we are improving. In terms of quantity, we are improving. In terms of cost reduction, better. Basically, that is that. So this is all that you do. So this is for material what? Material mix variance. Now, we now need to go and do the yield. And it is coming from this same methodology. So this one, to do your SQSM, AQSM. So that's all. Whenever you get your question, SQSM, and what? AQSM, difference, price, and you get your variance. That's all. It is all here. That's all. Then you probably you put the material. You can bring your mix, your yield. All right. So sorry. Okay. So standard mix, you find these ones, and that is all. But be careful. The yield is about the pricing. What are you multiplying it by? The same standard price. All right. So basically, that is that. All right. So we can take a question and look at that quickly. All right. Then we move on to the remaining two. Let's go. So we have the same question. We have handle producing the standard material for 1,000 units. The same thing, everything here the same. We are supposed to calculate the mid. I'll come back to explain to you what the mix. No, this one should supposed to be a yield, all right? Because we've done a mix. So let's do a yield. Variance. But before then, let's understand the yield. All right. So, but I'll also go back to the mix. So here, look at what we are measuring. We are measuring the efficiency in converting raw material into finished goods. That's all. The efficiency in converting raw materials into finished goods. So, and when we were looking at the mix, so what was the mix all about? The mix is about the different proportions that you can use, all right, other than the budget, all right, proportion of the material than the standard or the budget. So if you do and it is favorable, hallelujah. If you do and it is unfavorable, then I think you should go back to what you want to think about to do. So now we did, was this one adverse or favorable? I thought it was favorable. No. So let's correct that. Because it was 1650 adverse plus 12. So that is 28, and so it was favorable. All right, so that's what we had here. And now we have this. All right, so what you need to remember is that we learned that here it is standard quantity for what? Actual production. Remember that. It's very, very important to remember, because if you mix that one up, you'll be in trouble. It's the same question, so I'm not going to waste time. Here I have material A, B, and C. AQSM has been done before. We have 12,500, 5,000, and we have what? 5,500. All right, so that is that. So what we are actually left to do, and our mix is also here. So what is the standard quantity for actual production? The standard quantity is here. The standard quantity for actual production. You see, they produce this 21,000, but our standard was for this. So if we did a standard for 1,000 and they produce this, then it means that we can do 21,000 divided by 1,000. That gives us 21. So whatever we are doing, the standard here has to be multiplied by it, because for actual production, we did a standard for 1,000, but the actual is 21,000, which means that we need to multiply everything we do by 21, 21, 21, 21. All right, that is the 21 is the 21,000 out of our 1,000. That gives 21. So be careful about that side. All right, that's all. Apart from that, you are good to go. So you know the standard quantity for actual production and the standard mix. The standard mix is here. So what is the standard quantity for actual production? So you are going to do, first of is 600,002. That is the mix part, which gives you 0. What? 0.5. Basically, that is that. So what is the standard quantity for actual production? You remember, this is it by 21. All right, so multiply by 21,002. That gives me 12,600. So that is it. That is all you are doing. Because listen, your standard was for 1,000 units, but the actual production was this, which means that the 1,002 total that you did here, it was for 1,000 units. But the quantity here that they've done was for 21,000 units. So you have to also make it about your 21,000 units. All right. So basically, that is that. So when I do this one, the mix, standard mix, which is a second one is 240. The mix by divided by 1,002. That is for the SM part, which gives me 0.2. But what is the standard quantity for actual production? Standard quantity is 240 by 21. That gives me 5040. Basically, that is that. So this one too, it will be 21 by 1,002. All right. And I'm multiplying it by 360 divided by the 1,002. And I have 7,560. So basically, that is that. So what do you do here? Here is 100. Here is 40. Here is it, what is that? No, this one was 7,500, right? 7,000. That's AQ. AQSM. So this one is 60. Good. So here we have 1.1, 2.4, 1.5. All right. So by here will be giving me how much? That's 110. Favorable, you could see is bigger. Here to the same thing, favorable. I think they are all favorable. So 40 by 2.4, that is 96 favorable. Then 60 by 1.5, that is 90 favorable. So favorable. So shall it be in your exams? 296 favorable. All right, so that is that. All right, that is that. But don't forget this part is for actual production. It's very, very important. All right, that is that. All right, you can also use this shortcut. All right, I think because of approximations. Yeah, can also use this shortcut for your solution, whereby you get the actual output. All right, which is always given. The actual output, which is always given. All right, then you do expected output from the actual product. Find the difference, you multiply it by. But I don't advise this, sincerely speaking. Very soon I'll take it out of the manual. So this is your cool way to go. It's as simple as that. But remember, it is standard quantity for actual production. All right. That is that. Standard quantity for actual production. When you remember that, you are good to go. All right. So ladies and gentlemen, this is it for the two. All right. This is it for the two. Let me see if I can get another question for us to try. Found one. Let's do this one quickly. It says that these are the standards. 3 kg and the price is 3 kg for a unit and the price is this. And the actuals has also been given. We are supposed to prepare basic variance, or this is basic, and assess whether the purchasing manager and the production manager individually have done a good job or a bad job. All right, so basic variance, remember basic variance. Okay, so here we have the materials and we have everything. Don't forget, this is a purchasing manager and the production manager. So we are looking at what the quantity that they brought and the production that they've done. So the material cost, basic variance, we would have needed standard quantity multiplied by what? Standard price. And the actual quantity multiplied by actual price. You say you change this to AQ and you maintain the SP. And if I want to do my my quantity variance, material quantity usage, and if I want to also do the price, I use this. So in the first video, you will see me doing, but again, let me say this is standard quantity for what? Always remember, for actual production. Remember that. All right. So in the basic variance, you see me go straight like doing SQ minus AQ SP straight away. All right. So here, what will you do? So if you want to do, depending on the formula that you use, here too will be what? SP. All right. So here was what? AP, sorry, not AQ. So it will be SP, AP, AQ. So in the basic variance video, you see me go straight like this, but these are the formations. All right. So now, if you pick what is the standard quantity for actual production, we will need 3 kg per unit, but the actual production is 12,500. So it will be 12,500 multiplied by 3 kg. That gives me 37,500. All right. So basically, that is that. Or you can also divide the actual by this. Okay. So that is that. Okay. But so we multiply this thing by what is the standard price? The standard price is 5. Good. Then you come here. What is actual quantity? The actual quantity that has been done here is how much? Quantity of kg is 38,000 kg. All right. Standard price 5. Then you can also arrange the last one, which is actual quantity. What is the actual quantity? Which is 38,000 kg multiplied by the price. All right. So here, look at this. If I want the price, actual price, I can divide this by this to find the actual price. But you could see clearly that the cost has been given to you to be 195,500. You could see clearly that. But if you still want to, it is telling you that you have what is the so that is it. So this one, the AQ, 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 AQ. So this will be, if you want the price per unit, it is 195,538. That is giving me 5.14. So you can have that if you want. All right. So 5.14. And when you multiply, you already have the cost. All right. So that is that. So this one, 37,500 multiplied by 5. That gives me 187,500. Then 38,000 multiplied by 5. That is 190,000. Okay. So if I want my variances, I can compare this one and this one. And what is the difference? 187,500. That gives me 2,500. Adverse or favorable? Clearly, you could see it is adverse. Can you see? So here, that is how you do that. And whatever I'm going to get here is 5,500, right? That one too, is it adverse or favorable? So this, between this and this, adverse or favorable? Adverse, right? So in total, what do we have? Is it 8,000 adverse? All right, so that is what we have here in total. Now let's go to the next. We are told that after further consideration, the standard has been revised to reflect the changes that have occurred over time. The revised standard is now expected to be 3.1 kg due to poor, but before it was what, 3. So now it has been revised upward, 3.1, all right. In addition, due to adverse the material cost, it is now also expected to be 5.1. So now we have been asked to prepare a variance. What does this variance actually mean? This one will mean that our profit is going to go down, all right, so by 8,000. That is the meaning. All right, so it said that prepare analysis of the variance into both planning and operational. You remember our planning on operational? So it's very, very up there. Planning on operational, very, very up here. All right, so this is what we are going to do. So we are going to use this one to do the next things here. So these are the things. So standard quantity, standard price. So the first one, standard quantity, standard price. What was the standard quantity? The standard quantity is that we use standard quantity for actual production was that we use this 3, all right, to produce 1 unit. All right. And when we were doing this, I think you saw the standard quantity, quick proco. So you did this. So if you are continuing your work, I think you can pick it from here. Standard quantity for actual production. This is it. All right. So basically that is that. So remember what we do. Planning and operation. Okay. So what did we do? We say standard quantity, standard price. All right. When I'm developing the entire formula down, standard quantity, actual price. Then the next thing for us to do is what? You change this with maintaining the others. But let's put the down side, the down one first. So actual quantity, actual price. All right. So that is what we have. So we said we would change this one to what? RS scale. RS scale while we maintain our price. Then we will maintain this RS scale. Then we come to RSP, right? That is it. Then lastly, we come to our AQ as we maintain our RSP, just to help us do the variances. Okay, so if you pick it, what is the standard quantity? And anytime we are talking about standard quantity, we are talking about standard quantity for actual production, which when we did here, it is 12,500 multiplied by the 3. We had what, 37,500. All right, and they've changed it to 3.1, so it will be 3.1 multiplied by 12,500. Let's move 3.1, 12,500. That is 38,750. So here to 38,750. All right. Then here the price is still the same. What is the price? Standard price was 5, right? Yeah, 5. The revised price is 5.15. What is the actual quantity? We had it here. We don't need to go anywhere. Remember, 38,000. And it was even given straight up. So 38,000. 38,000. What is the revised standard price? Is the same. 5.15. But what is the actual price? So this one was the revised then. In addition, due to blah, 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 the exchange rates have changed. It is now expected to be this. But the actual price of the thing we saw was 5.14 before. Right? Okay, so here we already had 195,500. Okay, so 37,500 by 5. I think we had that one too already. 187,500. 38,750 by 5. I think I have 38,750 multiplied by 5. 193,750. 38,750 multiplied by 5.15. I have 199,562.5. So if I round it, I'll get this. So another 5.15 multiplying, 5.15 multiplying 38,000 is 195,700. All right, so that is that. Now, all you need to do is to do the planning, usage, planning, operational price, like that. All right, so this one, the first one, I have to do it from the last because that's the last figure that I have. 195,500. This is 200. All right, so that is that. Then here is what 187,500 minus 193,750. 6250 adverse, you can see. Then 193,750 minus 199,563 is 5813 adverse. Then that same 199,563 minus 195,700, that is 3863 favorable. All right, so that is what I have here. Now, if I now check the entire thing here, You can check. You can check everything here. So, and find the total variance that you can have for that. All right. So that is that. Okay. All right. But if let me finish this thing up quickly. All right. So let's say this is your price, operational and planning. Operational is 4063 favorable, right? And planning 6250 plus 5813 12,063 adverse. So this is the planning. And if you compare it to what we did before, 8,000 adverse, what is the difference? That will be 4063 adverse. So it means that if you had not replanned, you would think that this is like a saving. You think that this is the variance that you would have had to judge the people, but this is actually the reality, or the proper planning that they should do. And this is a saving. You have saved judgmental judging the people. You see, if you had done this 8,000 at the end of the day, it would have gone out by this. You would have judged them wrongly. But per the planning, you see that the adverse is actually high, so they can make amends now. All right. So, ladies and gentlemen, in the next phase of this video, the part 2, we are going to look at the remaining two variances. All right. That is that. In the advance, then that will be it. We'll move on to CVP. All right. So, thank you. Have a great day.